For more on this, we're joined by Farah Mourad in Dubai. She's a senior market analyst at the IG Group. Welcome back to the programme, Farah. Now, oil prices have gained around 18% this week. How are markets navigating this volatile environment?
Thank you, Taiba, for having me. So obviously the key point is that oil is not rising because demand suddenly spiked. Obviously, it's rising because of fear that supply could be disrupted. That matters because before that, we assumed that the fear premium can be reversed quickly, and maybe one piece headline or credible piece headlines can affect this premium. Now we have shifted this outlook. We believe it's no longer just a spike. It can be long-lived, and this matters because of the possible duration and intensity, and it's not only affecting the supply, but also the infrastructure. So this is an inflation story. It's a growth story. Even Donald Trump today or yesterday suggested to his people that this energy crisis can be long-lived. So now we believe, or we shift from the previous outlook that this is maybe a volatility spike, a short-term spike, and it seems like it will last for longer.
And looking over at Taiwan, JP Morgan says the financial regulators' move to ease limits on single stock fund holdings could draw in more than $6 billion of inflows. How does this benefit Taiwan's tech sector?
Hugely. I mean, the outlook seems very possible. We still need to see the whole risk appetite globally, how it will react to global inflation and other stories. But obviously, we've seen maybe return back to AI story. And this news, whatever was gatekeeping maybe, flows into Taiwan's semiconductor industry is now removed. We expect to see a spike. We're seeing it already. How long-lived is it going to be on the short term? It really depends on the geopolitical tension, oil prices, obviously. But for the long term, it's a positive story, not only for Taiwan or for the semiconductor industry in Taiwan, but we might see it also echoing globally in tech and AI-related stocks.
And what side effects could arise from a large influx of capital into single stock focused funds across the region?
Obviously, why it was in place already, it was because of maybe a forced diversification away from what's mainly popular. But that also maybe restrained fund managers to maybe reinforce or bet stronger on what they believe is a growth story or stocks that they want to buy. So the side effect is a possibility of a higher or less diversification, more crowded trade, which in case anything happened or any bad news, we obviously know how highly concentrated trades can unwind fast and reverberates over other sectors and other stocks. Especially a stock related that much to infrastructure and AI.
Right, we'll leave it there for now. Farah Mourad in Dubai, thank you very much for your analysis.